Why are some of the world's best-known companies trading at steep discounts right now? And is that a warning sign or the buying opportunity of the year? The honest answer? For a handful of these stocks, it's actually the second one. And this week's market action just handed you a clear list. Right now, we're watching a real split happen in the market. The S&P 500 is sitting near all-time highs, tech giants are printing record profits, and yet underneath that headline number, several major companies have been quietly beaten down 20, 30, even 40% from their highs this year. That gap between the index and individual stocks is exactly where opportunity tends to hide. So today, we're breaking down 4 beaten-down names making headlines this week, why they fell, and why analysts think they could be setting up for a real turnaround. Let's start with Marvell Technology. This is a chip maker at the center of the AI infrastructure boom, building custom silicon and high-speed optical connections for data centers, and yet the stock is trading roughly 40% below its 52-week high, even after being up over 100% for the year at one point. So what happened? A wave of profit-taking hit the entire semiconductor sector after Samsung's earnings triggered a sell-the-news reaction back in early July. Then TSMC piled on, beating on revenue but spooking investors with a much bigger capital spending plan for next year, which raised fears that chip margins across the industry could get squeezed. On top of that, Marvell lost a technical tailwind after its inclusion in the S&P 500 was fully priced in, and insiders sold around $27 million in stock with no reported buying, which never helps sentiment. But here's the case for why it could bounce back. The core business hasn't actually deteriorated. Demand for custom AI chips and optical interconnects from hyperscalers remains, in TSMC's own words, extremely robust. Marvell is still up over 100% since the start of the year despite this pullback, and it's trading well above both its 100- and 200-day moving averages, meaning the long-term uptrend is still technically intact. This looks far more like a sentiment-driven correction than a fundamental breakdown, and historically, this stock has recovered from similar shocks in a matter of months once the broader macro picture stabilizes. Next, let's talk about Lennar, one of the largest home builders in the country. Shares have fallen more than 20% this year, and in one especially brutal month back in the spring, the stock dropped over 20% in a single stretch after an earnings miss. The core problem is affordability. Mortgage rates near 6.5% have squeezed buyers, forcing Lennar to lean heavily on price incentives and mortgage rate buydowns just to keep homes moving, and that strategy has crushed profit margins in the short term. So why might this be a buying opportunity instead of a falling knife? Lennar has been getting leaner at exactly the right time. The company cut its inventory roughly in half over the past 2 years, spun off $6 billion of land holdings to reduce balance sheet risk, and is running one of the most capital-efficient models among major builders. And there's a bigger structural story underneath all of this. The US still has a real shortage of existing homes for sale, which means demand for new construction isn't going away. It's just waiting for rates to ease. If the Fed does eventually pivot toward cuts and mortgage rates drift back down, home builders like Lennar are typically among the first stocks to catch a sharp relief rally. Third on the list is Snap. This one has had a rough couple of years, with shares down more than 20%, as the digital advertising market went through a slower recovery than investors hoped, and user growth cooled compared to bigger platforms. Advertisers pulled back budgets during periods of economic uncertainty, and Snap simply doesn't have the same scale advantage as its biggest competitors, which makes it more vulnerable when ad spending gets cautious. But analysts are actually turning more optimistic here. Estimates for next year's earnings growth have been revised sharply higher in just the past couple of months, with some projections now calling for sales growth north of 13% and earnings growth above 50% year over year. This is a classic high-risk, high-reward turnaround setup. Snap doesn't need explosive new user growth to move the stock. It just needs digital ad budgets to keep normalizing and management to keep showing cost discipline, and sentiment on a beaten-down stock like this can shift fast once the trend actually turns. And finally, a name that flies a bit more under the radar, Workiva. This is an enterprise software company that automates financial reporting and compliance work for large organizations. The stock has fallen nearly 34% this year, largely because investors have grown nervous about the entire subscription software sector, fearing that AI tools could eventually make some of these platforms less necessary. That fear has weighed on valuations across software broadly, not just Workiva specifically. Here's the counterpoint. Despite that fear, Workiva just posted an 89% earnings per share gain the year before, and current projections still call for a 63% increase this year, which would mark its transition into sustained profitability after more than a decade of steady double-digit revenue growth. The company keeps landing large enterprise customers and maintaining strong gross margins, which suggests the market may be pricing in a worst-case AI disruption scenario that hasn't actually shown up in the numbers yet. So what ties all four of these together? None of them are broken businesses. Marvell's core AI silicon demand hasn't slowed down. Lennar has been quietly repairing its balance sheet in the background. Snap's earnings estimates are trending up, not down, and Workiva keeps growing despite the fear surrounding it. In every case, the sell-off has been driven more by macro sentiment, sector rotation, and short-term fear than by an actual breakdown in the underlying business. That's usually the exact setup value investors look for: strong fundamentals, temporarily depressed prices, and a market that hasn't caught up yet. Now, to be clear, beaten down doesn't automatically mean undervalued. Some stocks fall because the story really is deteriorating, so always look past the price chart and into the actual reasons behind the drop before deciding anything is a real opportunity. But when the reasons behind a decline are sentiment and sector-wide rotation rather than company-specific failure, that's historically where some of the best long-term returns have come from. And that's exactly the kind of analysis I want to keep bringing you every single week. Markets move fast, and the difference between panic selling a great company and buying it at a discount usually comes down to actually understanding why a stock fell in the first place, not just seeing a red number on a chart. That's the entire mission of this channel. So if this video helped you look at even one of these stocks differently, hit subscribe to the Freedom Escape. Every week, I break down what's actually moving global markets: stocks, the Fed, crypto, earnings, so you can make smarter decisions with your money instead of just reacting to headlines. Turn on notifications, subscribe now, and I'll see you in the next video.